I have two crumbs of comfort. First of all, in terms of the impact of higher interest rates on UK households, because we now have a relatively large chunk of debt that is fixed term, actually the rollover of debt that was put in place 5 years ago means that even if we get a rate hike, we're going to see lower costs to consumers. So that we're going to have a very material hike in money rates, which I definitely do not think is on the cards, for there to be an adverse impact on the capacity for consumers to spend. The other big changer for me is that we now have the central bank of China rather than simply the local authorities wading in. And if the central bank is prepared to spend $1 trillion, it may look small in the context of prior participations in stopping markets declining, but actually this feels much more Keynesian than monetarist, and therefore I'm really excited that China is actually going to sort out its problems and allow the global economy to continue to move forward.
But if China's problems are that nobody else is buying its products, then further stimulus at home isn't going to solve that problem, is it? I mean, if you look at the data that we talked about this morning, it's all about the decline in exports and its impact on manufacturing prices. And even as the Chinese have tried to prop up this sector of their economy, the fact we've got weak demand for their products elsewhere means it's tough, isn't it?
It's really interesting. If you were to cut up the S&P 500 and look at the results that we've had so far, almost all of the bad news has been energy related, either directly or indirectly. And you take the railroad stocks. Railroad stocks have been hammered recently, not because actually the volume of goods that have been traded via the railways has been declining, but because energy is well down and a large chunk of energy is on the railroads. Lower energy costs, however, will ultimately be extremely good news for consumers, and I think we slightly have the wrong eye on the wrong target, and that a lot of the forward-looking data, either out of the US or indeed out of Europe, is now looking much more propitious and much more supportive.
World trade over the first 6 months of the year has shrunk 4%.
That is terrifying. I absolutely agree. The deflation risks are still really frightening, and we do have to make sure that we don't move into a world where we get progressive competitive devaluations that ultimately lead to embedded deflation and the real risk of a trade war. That is clearly the big risk.